Hello, everybody. I'm Michael Smith. Welcome to the Lowdown. And joining me today is special guest Kevin Lenox. Kevin, we're a month out from the election, and I'll tell you what, I don't know about you, but I can't wait just to get this completely out of the way. This, to me, brings out the worst of humanity, is when the United States has elections. You thin your friend list and you cut your social media list, so that's probably the only good thing about that. But otherwise, we do have a lot of election uncertainty. I mean, I think you've heard both sides have lawyered up, so that means they're both prepared if this thing gets hung up. But, we're going to get through it, and I think once we do, obviously the market will trend. What direction that's going to be, I think, kind of relies on a lot of things. But you've got two camps right now, and I thought maybe you can kind of just lead us off into talking about each one. But you got the soft landing camp, right? So, again, we, kind of maybe have a sort of a recession, but it's more of a glide path. And then, of course, there's one that you have no landing, basically no recession. So why don't you kick us off and maybe start off with the soft landing and the case for it.
So the soft landing camp is the pure narrative through the market now. That's the expectation. Everything has been priced that way, and really sold well by Jay Powell, at the last Fed meeting, where he basically declared victory over inflation.
Yeah.
They cut by an unusual 50 basis points instead of 25 basis points, which they really felt like they should have cut 25 in July, but didn't.
Always.
So it wasn't really an emergency cut. It was a makeup type of a cut. But the narrative is that the Fed funds rate is now 5%. CPI is 2.5%. Core is a little bit more sticky at 3.2% on a year-over-year basis. But they think they've got plenty of runway to continue to cut interest rates without having inflation pick up again. And I think that's a risk that has not dissipated yet.
Well, yeah, I mean, absolutely. I think, the soft landing case, I mean, I think all things kind of have to be perfect, right? And, the rise of, we'll probably get into the case for, the no landing, but I mean, we got geopolitical risk, we got, oil markets moving, so we'll get into that in a little bit. And of course, the election is a very big uncertainty for the market. But what about the other side? What do you think the case for the no landing? What's got to happen there?
So number one, front and center, is the fiscal spending. It's 24% of GDP, which has only been higher after the Great Recession of 2008 and COVID. So it's really fiscal recklessness. You can blame both sides on it.
For sure.
And if you listen to both camps right now, neither side is talking about a reduction. And actually the worst case scenario for inflation would be either a red wave or a blue wave.
And why would that be?
Markets like gridlock. Because if one side, either side, controls Washington, then bad legislation, one-sided legislation can get passed. If there's gridlock, then that's not likely to happen. And it looks right now, let's keep flip-flopping at the presidential level, but everything I keep seeing, and it hasn't flip-flopped, is that it's a really tough road for the Democrats in the Senate. The Republicans have an advantage there, so it looks, and the Democrats actually could take the House.
Yeah.
That's potentially flipping now, but if we wind up with gridlock, I would say that's the best situation for the markets.
No, I agree. Actually, yesterday, so I'm on the Leadership Council for the National Federation of Independent Business, NFIB. So we had our call yesterday, and this is typically where, they don't get involved in a presidential race in terms of calling who's going to win, but they get very involved in terms of Senate and congressional. And so they did concur that they believe, you could have it'd be pretty difficult not to see the Republicans take the Senate at this point. But they also do agree that there's, potential for that Democrats could control the congressional side. So that would lead to the gridlock, as you mentioned.
And if we have that, then that eases some pressure on the fiscal side. And then if you look at the soft landing narrative, then, we've got wage growth of still 4%, which is higher than target, but worker productivity, which is key, has increased. It's now 2.7% on a year-over-year basis and trending higher. And perhaps AI and other productivity enhancements are helping that along. So that kind of helps support the soft landing narrative. And then, of course, you have demographics as well.
Sure. Well, so having you on a show today is a couple of things I wanted to go through, and they'll probably all kind of feed into the soft landing, no landing scenario. But yes, here last week we heard China was going to put some stimulus in the market, right? So we're going to see a little bit more liquidity come in. But then all of a sudden yesterday something happened. I thought maybe you could share what exactly happened if you know. But it looked like they kind of backed off of that, and Chinese stocks took a major decline after a big bounce. What's going on with China? What is this? What's happening here?
Yeah, so a lot of people were completely out of China, short China, and then they came out with basically a monetary policy bazooka.
It's like a short squeeze or what?
Exactly. Which caught people flat-footed.
Okay.
And then we had this huge run-up that then just fed on itself.
So we'll teach you hedge funds to short China, right?
And then it's like, okay, so do these policies really fix the issues within the property market? Probably not.
No.
And most were saying that they're really going to need QE. For this to become more of a broad-based economic platform that they can grow on.
As we follow the Japanese, they'll follow the U.S. Okay.
So I think at this point it's viewed as we talked about before the show as a trade.
Yeah.
Rather than an investment at this point.
Well, they were, completely beaten down and battered. I think you and I are in a camp when something's just so beaten up and nobody likes it. I typically like to take a trade in that scenario. So, so I agree with you. It was definitely a trade.
Uninvestable.
When
they come out with a big from a big investment house, I get pretty excited. I don't always trade it, but it's like that means everybody's out. And all you need is something to go right, some unexpected news to the positive side, like we had with oil in late 20, early 21. Mm-hmm. And everybody comes back in. That can be an easy trade.
Well, so speaking of oil, I'm glad you mentioned that. So right now, I think we have a pretty big geopolitical risk, right? So obviously, I think there's two ways to look at oil, and definitely please comment on this. But I think, you've got obviously the price action. If there's any type of retaliation and destruction of Iran's, oil resources or oil production, that could bring production offline. But historically, OPEC has always been able to fill that gap. However, there's another side of it. If there's a blockage of the Strait of Hormuz, that's a whole different story. That could be a lot more, I guess, catastrophic for the markets than a shortage of Iran or a destruction of Iran. But what are your thoughts on oil right now and those scenarios?
So I've always said, if you want to make someone look foolish, ask them for their 6-month forecast on oil.
Yeah.
There's so many variables
at
play, and it looked like Israel was ready to retaliate in a big way. Mm-hmm. And it looks like representatives from the U.S. have been able to talk them down off of that immediate, very harsh response. I think blocking the Straits of Hormuz is a low probability, would be my guess. But we're going to continue to have these risk flares that have put a bid in for oil that before Jay Powell's rate cut was not in oil. It was, the consensus was excess supply next year, and some of the big E&P companies were forecasting $65 or so Brent next year. So and that's, oil has a lot to do with how this soft landing or no landing is going to play.
That's why I'm asking this.
High degree of correlation between oil prices and inflationary pressures and future expectations.
Well, even if OPEC does come in, if there is an issue with Iran's infrastructure, typically there is a lag on that. So that is something to consider. So either way, if we do see some retaliation or disruption of the Strait of Hormuz, there's going to be a lag effect there either way, in my opinion.
And Russia's oil fields are getting pressure as well from Ukraine.
Yeah.
From refiners and fields as well, from what I understand.
So oil volatility is definitely probably something in the cards.
Yeah.
So Kevin, I want to come back to something, and typically you want to see what's going to happen or know what direction things are going. It's not so much the stock market, but it's the 800-pound gorilla, the bond market, right? The bond market's what really moves things. And so, you've got a lot of people talking about, again, soft landing, no landing. But, I've heard here legendary investor Stanley Druckenmiller. And so for those who don't know who Stanley Druckenmiller is, he is probably got one of the best track records of any hedge fund manager in history. And he has come out here, and I think it was at a conference, and he has taken a different side to the bond market. And, I typically don't want to be on the other side of Stanley Druckenmiller. But could you kind of maybe lay out what were some of the comments he made? What side is he taking? And I guess as an investor, where should you be?
Never on the opposite side.
Exactly.
He is one of my heroes.
Yeah.
I read and listen to everything that he puts out. He's famous for, and this can help on other fronts as well, the ways he looks at the stock market. For example, he said the best economist he knows is inside the stock market. And that is, how are cyclical stocks doing relative to defensive stocks? And I found that personally very, very helpful in asset allocation. So he was at a conference, and he mentioned that 10 to 15% of his portfolio is short the bond market.
Okay. What does that mean?
Betting that rates are going higher.
Okay.
He said he doesn't know whether that's a 6-month call or a 6-year call, but that the fiscal spending is out of hand. There's no effort to minimize it whatsoever, regardless of who's in Washington.
Agreed.
Who's pulling the strings. So that was largely what he focused on. He said that George Soros would probably be very disappointed in him, that he didn't make the bets substantially larger. He's known for, if you have very high conviction, you move the chips to the middle of the table.
Yeah.
It doesn't come around very often. If you really think you're right, do it.
Yeah.
So it was mainly around the fiscal side is what he was talking about. But when you look at other issues that feed into the structurally higher level of inflation, deglobalization. So we've ripped up global supply chains, and if you look at Taiwan Semiconductor, for example, moving their chip manufacturing part of it from Taiwan, which is under fire right now, to Phoenix. And it's come across all kinds of cost overruns, cultural mismatches.
With the heat?
Technical.
That'd be the first one.
Technical expertise, regulation, and just the chips coming from that are going to be meaningfully more expensive than those that come from Taiwan. And Taiwan makes 92% of all the advanced chips in the world. So just as an example, if you look at other reshoring, friendshoring, there was supposed to be a LCD facility in, I believe it was Wisconsin.
Okay.
And now it's going to be a data center because they couldn't get the personnel and such to work out. So if that trend continues, it would suggest a higher level of inflation. Other protectionism like tariffs. Yeah. And then cost of upgrading the grid.
So the benefits
all that AI
of
is going to consume, and we're probably going to have to do some of these small nuclear reactors.
Agreed.
Not the large ones, but there's a huge
pop-up nuclear. Yeah.
And easier to shut down. And I think we're moving in that direction. And there's a structural shortage of commodities, especially like copper, that can be used in building out the grid. So I'm more aligned with Stanley Druckenmiller in this, and I have been for several shows. Yeah, that's not news. I just don't see us dropping down to 2% inflation, which is the Fed target, and staying there. I think more in the 3 to up to 4%, not 7-8%, not the 1970s even, but just a structurally higher plateau. Some of the things in the soft landing camp I think are real. The advancements from AI, improvements in productivity, demographics, that's all real. That will have an impact. But the way things look structurally now, it's for a higher level, a higher neutral rate than the Fed thinks it is.
Well, perhaps,
you look at earnings up 8% this year. Now with the Fed cuts, they've moved it up to 11% for next year. Wage growth of 4%, GDP at 3%. Financial conditions looser now than they were when the Fed first started cutting rates. And where's the room to go significantly lower in rates? And let's not forget, you continue to cut rates. The top quintile of households in income control about 60% of the spending. So if you cut rates, what are the top quintile going to do? Spend more, which can reignite inflation, and then Powell becomes Burns.
Yeah, well, it is. Yeah, no kidding. Well, it is concerning because I think the majority of individuals, majority of people out there, they think, okay, well, Fed's trending to cut rates. That's going to mean lower interest rates. I mean, and the National Federation of Independent Business capex spending at the floor. It's at the lowest levels we've seen since I think the 73-75 recession, and so they're waiting. It's a 6-month forecast, and so right now they're kind of the uncertainty with the election. Seeing if the Fed continues cutting rates, they're kind of waiting, but plans to expand are at their lowest levels. And perhaps Druckenmiller's position why it's low is he said 6 months to 6 years. That's a pretty wide forecast, right? So perhaps that's why he took a smaller position. But I think in the long term, you think about small business, you got to kind of time it right because maybe rates go lower for a little while. You got to try to borrow then. You can't be thinking that it's going to go down each year. And I think that's the consensus is that, okay, this is going to go down. We're going to get back to the low 2% that we've seen in the past. Mm-hmm. And I think that could be a big misconception that could lead to further issues. So not being on the wrong side, I don't want to be on the other side of Stanley Druckenmiller. Mm-hmm. So as an investor, right, if you're hearing this, what do you do? What is the best way to insulate yourself if you're looking, I guess on your bond side of the portfolio? How do you invest in this to, insulate yourself from this whole concern?
Yeah, so I think, trying to make an interest rate call here is, as I say, there are two types of people that forecast interest rates. Those who don't know, and then those who don't know they don't know.
This is the most dangerous.
You can make good case for both, as we did here.
Yeah.
But I think a laddered type of bond portfolio makes the most sense. The best way to mitigate interest rate risk, and you can build that out to 7, 8, or 10 years.
Okay, I was going to ask you duration.
The idea is that periodically you've got a bond that matures.
Yeah.
That you then reinvest further out on the curve, and the rate is what the rate is. And you're not betting on rates coming down. You're not betting on rates going up. It's a smoother ride, argue a better way on a risk-managed basis to manage your bond portfolio.
And then I would probably add too, looking at alternatives for yield, mixing that in there as well between a stock and bond portfolio. So another way to mitigate that as well.
Alternatives like infrastructure,
correct,
for example,
yeah.
or more contract-based especially.
Mm-hmm. Mm-hmm. Well, great. Well, anything else you could throw in there? We'll be back here after the election, and of course we're going to have plenty to talk about. But anything else you want to add before we end here?
I think it's a great time with potential for higher volatility, particularly on the commodity side. Is take a look at the risk in your portfolio and, the asset class concentrations. I continue to, see managed and unmanaged portfolios by people that, really have concentrated risk that they're not aware of. And one of the good things we do here is, third-party software to really identify the factors and the biases in the portfolio.
Well, I'll add to that. I think, again, position yourself ahead of what's coming, which is probably some volatility. Whatever you position yourself now, don't spook yourself out of it. There'll probably be a lot of short-term vol that could be made up. So I would just be cautious. So get positioned now, plan to hold. Let's wait it through, and then we'll be talking to you here soon. Kevin, thanks for coming.
Sure.